Hi everyone, welcome back to Risk Biscuits. Thanks for coming on the show, or coming back to the show, I should say. Merry Christmas, happy holidays to everyone. As always, if you enjoy the show, please like, subscribe, follow, all that sort of good stuff. It helps the show your support. Today I've got a very special guest. I'm actually very nervous, but in a good way. Euan Sinclair has agreed to come on the show. G'day, Euan. How are you?
I'm good. Thanks for inviting me.
Oh, you're welcome. Look, obviously, Ewan's reputation will precede him for many, but before we sort of get into all of that, I'll just put something up on the screen. Just to, where are we? Look, just a bit of a disclaimer. Obviously, this is really just meant for entertainment purposes. It's general conversation. Nothing's intended to be financial advice. I'm just a regular retail punter, and Ewan's not really interested in providing advice today. So if you're looking for advice, go somewhere else. If you're looking just to listen to a general chat and a conversation, then you're in the right spot. All right, so let's get started. So maybe Ewan, if it's okay with you, I guess just kind of sort of say what I think I know about you in terms of who you are and sort of your place in the world, and you can correct me if I'm wrong, or we can kind of go from there. So Euan Sinclair's an options trader, been in the industry for 20, 25 years or something like that. I think has a PhD in physics or something along those lines. Um, Written several books, all of which I've read, um, with varying degrees of sort of the information being absorbed. But is that kind of generally a fair comment, Euan, and what you're up to in the market these days?
Yeah, pretty much. I think I've done a lot of different things in the options world. I started off as a market maker. Then I was a quantitative position trader. I did risk management. I managed a group. I had a hedge fund. And then I've been trading for my PA for the last, I don't know, 6, 7 years, I think.
Yeah, cool.
Um, so I've done a lot of things. Yeah.
Yeah, nice. And what kind of drove I guess, the move away from trading at sort of an institutional level to like just trading for yourself? Was that just about flexibility and life and that sort of thing? Or
It's one of those decisions in life that doesn't really happen for any particular reason. It just sort of seems like where I was, the path had finished. It just felt like time for a break. Like I worked with the same people ever since I graduated. So it was about 15 years at that point. I got to the point where it was more about managing risk rather than just looking after myself. And the firm was big enough, there was always something bad going on somewhere. And so basically, it just becomes a very draining job to
okay,
always be involved in the bad stuff. And
yep,
so eventually I just was like, you know what, I'm done. And I stayed done for about a year before I got back into it again. Um, I just needed a break, basically.
yeah, fair enough. So I obviously read your bio, and you come from a sort of a physics background. So what came first? Did physics or trading come first in terms of your passion or your interests?
Okay, so I grew up in New Zealand in the 80s. Uh, there was no trading. Like it was a very different world back then everywhere. But in America, people were aware of futures markets and options markets and stock trading. I mean, the fees and the commissions were ridiculous, but you could do it. It was a real thing. And if you read like the First Market Wizards book or something, they're talking about people who are actually retail traders. That's their job.
Yeah.
I mean, that didn't exist in New Zealand in the same way that you couldn't be a dragon tamer. It just wasn't there. And even in England, it was similar. Like there was no culture of stock market trading in the same way there was in the US.
Okay.
So, and let alone derivatives. Like the first I'd heard of derivatives was when Nick Leeson blew up Barings. And that was the first time it became big news outside the financial world in England. And that's when everyone was talking about it. And that's when magazines like actually New Scientist, Scientific American were writing about, physicists getting into options.
Okay.
So that's sort of where I fell into it from. Towards the end of my physics PhD, I was looking around for things to do. And
Yeah. Okay.
it was kind of the fashionable thing to do. Like 3 of my 5 flatmates went into the financial world.
Okay. All right. So an overlap in terms of your skill set and a demand in the industry, and
Well,
um, I guess it's
there was an overlap in what people thought physicists could do. There wasn't really much of a direct overlap in what physicists actually do and what people in the financial world actually do.
okay.
And I think the recruiters and the banks found that out, but it took them 5 to 10 years to figure that out.
Fair enough. Just get in a bunch of smart guys with PhDs, and they'll figure it out.
Yeah, and to be fair to them, back then you kind of had to. There were no MFE programs. Even finance courses at university, they might have one, a 6-week section on options and futures, but they probably wouldn't. There were
Yeah.
no books. The only book around was Hull, and that was it. Like literally, that was it.
Okay. Yeah. Right. Okay. Very different world. Okay. So you've done your PhD. You've sort of fallen into the financial world and your sort of first role. And so, what were you doing in the beginning? I guess what was it sort of like working in finance, and what did you find sort of interesting about it coming from a physics background?
Um, the first thing I noticed, well, 2 things. First, I had to get up very early. And as a PhD student, I'd fallen into this really nice habit of waking up around 11, immediately going to the pub for lunch, and then probably cruising into the office around 2.
That's great.
Um, it wasn't a bad life, but then you'd work until 11. That
Yeah.
was it was just a different time thing. And then I got to the financial world in London, and I had to get up every morning at 5 o'clock because I had to be in there at 6. And so it was a matter of getting up as quickly as possible, making sure my hair wasn't in all sorts of directions, and like I'd be out the door in 5 minutes. And that was very, very different. But it led on to the other thing in academia, and I'm not disparaging academia, right? I still have a lot of respect for it. I'm still kind of involved in it. In academia, though, you've never got deadlines. Like, it astonished me the amount of work you could actually get done in 5 minutes. Because, it's not so much everyone's like, oh, the trading floor, it's such a fast-paced environment, blah, blah, blah. I mean, it kind of is. But you can actually do an awful lot. Like, it could be 3 minutes before the market opens, and I'll sit down at my computer at that point and I can get all my software done, and I'll be ready with 8 seconds to spare.
Yeah.
And that after a while, that doesn't seem like you're in a rush. That's just like, oh, I've got tons of time, no biggie. Whereas
Yeah.
before you come in, you're like, oh my God. I mean, the time pressure must be enormous. So that was a big change.
Yeah. Okay. And then so over the years, obviously it's been 20 years or 25 years or something. So how is obviously trading's changed in the sense that you're trading your PA now, but I guess your style or the way that you trade, how has that sort of changed over time?
Well, initially I was a market maker, and market making is a completely different job. It has practically nothing to do with sell side. I mean, yeah, buy side trading, where you're
Yep.
like putting on positions. I mean, most of the time, market makers don't have a theoretical value apart from where the market's trading. So
Yep.
they'll have a theoretical, but it's based entirely on the intersection of bids and offers. That's it. Whereas as a retail trader or as a hedge fund trader, that's not what you care about. You want to have like a theoretical value. So my theoretical value might be now, I think fair vol is 18 and the market's 26. To a market maker, he doesn't care if the fair vol's 18 or not. The market's 26 at 26.1, and he wants to be on both sides of those as many times as possible. So it's
Yep.
it's a completely different thing. And I think a lot of people think they can learn directly from what the market makers do. And that's, you really can't. It's such a different thing. And most of the time, market makers are really concerned with keeping the shop open,
Yeah.
doing whatever it takes in terms of tweaking this, getting the, making sure the margin's under control, making sure they're not getting too much inventory on one place. It's all inventory management. It is the same as what, I don't know, Woolworths or Target does. Whereas
Yeah.
it's a totally different thing. Whereas as a retail trader, you can sit around for 3 or 4 days coming up with an idea, and then the actual execution bit of it might be 30 seconds. Completely different. And I think one of the big mistakes people make is they're like, well, these professional traders are concentrating all day really hard. And you are. It's physically demanding, even if you're sitting in front of a computer, because you're thinking about every price all the time.
Yeah.
To a positional trader, that doesn't help you at all. Like, thinking really hard isn't going to make gold go up. You've got your position, when you're going to get out, when you're going to put more on, you're done. You're better off with that, turning off the screens and going and doing something actually useful. A lot of people get sucked into watching the screens and they think that's work. I mean, it's kind of mesmerizing. It's like a snake charm thing. It's not work. It's a complete waste of time, and you're not benefiting at all. And I hope most of your listeners they don't think they can read the market or something. I mean, if they think that, you have to do a bit more work in getting them over that.
Yeah.
So
Yeah, and like that's certainly the case for me. Like I have the bulk of my money in two positions that I rebalance quarterly, and I do a couple of other trades here and there. But at the most, I'm doing a trade a week type thing, and the rest of the time, there's really no need for me to be anywhere near the screen. And but it does have this kind of like charming effect sometimes, where you will sit at the screen, you'll be staring at it for a couple of hours, and you sort of
right.
you get into it, but then you realize that there's really no value in it at all because it's not gonna change what I'm doing in any way. So I may as well, go and do some work or do a
Yeah,
podcast or something.
I log in for the open and I
Yeah.
readjust, because I do a lot of active trading, like weekly options and stuff, and it
Yeah.
makes money, but it's mainly because I've kind of invested so much effort over the years, and coming to that point, I may as well just keep doing it. And then I
Yeah.
log in at the close to do any adjustments I might need to do. But I really try not to touch stuff, because every time you touch something, it costs you money. And oftentimes people don't really realize how awful costs are. Because individually, you're like, I just made $400 on that trade. What's an extra dollar in commissions?
Mm.
Well, the thing is, that dollar is always there, right? Whether you make money, whether you lose money, give me the dollar. It's
Yeah.
like that line from Goodfellas. You lost money, fuck you, pay me. You had a fire, fuck you, pay me. That's what commissions are like. That's what
Yeah.
brokers are like. Brokers are like the mafia. It's like, I don't care, fuck you, pay me.
Yeah, it's true. Yeah.
Yeah. So I think the ironic thing that most people should learn is that to be a better trader, you should trade a lot less.
Yeah. Yeah. I feel like I've learned that the hard way in many ways. And it's really only the last kind of 12, 18 months that I've just kind of settled into this being comfortable trading a lot less. And, I had this idea in my mind that to be a trader, you had to be trading a lot more often and involved in a lot more assets. And, whereas there's people that just do sort of one trade or a couple of trades and that's all they've been doing the same trade for 20 years type thing.
Yeah. And there are so many LARPers and stuff on Twitter who are like, I'm running this account with 40 different uncorrelated strategies. Firstly, none of that is true. Like, you're just not. There aren't that many uncorrelated strategies. There aren't really many things you can do, are there? You can buy shit when it goes down, or you can buy shit when it goes up. That's pretty much it.
Yeah.
And that's just not realistic, running one of those sort of multi-strategy, sort of micro alpha aggregation things. You can't do that as an individual. Like,
Yeah.
I always encourage people to add strategies to the point where they've added just too many. And they're like, oh my God, I can't keep up with this. And that's when you know your limit. And it gets
Okay.
easy.
Yep.
Like
Yep.
I can probably trade more stuff than someone who's just starting because I've got more experience. But
Yep.
I'm not going to have positions on in more than 20 or 30 stocks. There's no way. I can't do it.
Yeah. Okay. And if you've got that many positions on, is that generally applying just one or two strategies? Like how many sort of strategies would you run generally before it's overwhelming?
Um, So with the single stock stuff, it's almost always volatility premium harvesting. So, I'll be short weekly options, say, and I'll rebalance them with weeklies. Probably you have to do it every day. So they cost
Yep.
a lot, but the edge is high. And then I'll do the sort of calendar based stuff that, James Hodges talks about a lot on
Yep.
Twitter. And I'll do VIX shorting stuff as well, because that's a different kind of risk premium. But those things don't require they're not very high touch.
Hmm.
I've been short VXX for, I don't know, over a year. So you have to
Yeah.
rebalance it. But if you miss rebalancing it, so you've got 1% on too much or too little, you can
Yeah.
live with that. Whereas
Yeah.
like a 1 week option strategy, you better pay attention to that one.
Yeah. Okay. Fair enough. And then obviously I've read the books and I trade futures and I've traded options in the past, mostly for hedging. And I've done some sort of calendar spreads in VIX and that sort of thing. So, I guess I know enough about volatility in options to sort of know that I don't know anything about volatility in options, which is in a lot of ways a good place to be because I sort of know it's there, but I sort of know that I don't really understand it, if that makes sense. Um, Compared to someone like yourself who's lived it and breathed it and, intuitively understands the math on a deep level, if that makes sense. So, but the thing that I notice, I guess from your post on Twitter and James and various other people is like when you cut through all the kind of fancy option strategies and mumbo jumbo and stuff that people talk about, is it really just you're either taking primarily a position on long or short vol, and generally it's short vol because that pays, and long vol is more just for your hedging and your tail strategies. Is that a fair comment or is that naive?
Yeah, that's pretty much right. I mean, whenever you're trading options, you're trading volatility, whether you think you are or you're not. So
Hmm.
this idea of I'm going to buy these teeny options because it's a highly leveraged cheap bet. I mean, a highly leveraged cheap a lottery ticket is also a highly leveraged cheap bet, but it's
Yep.
also equally stupid. You're still paying too much for the bet. And
Yep.
I think a lot of people with trading, they forget that. It's a very odd sort of business because every other business in the world wants to buy something below what it's worth and sell it for more than it's worth. But you'll often have traders have no idea of actual value of an option, but they'll just buy it because they think it's going to go higher. Well, maybe it will, but if you paid too much for it in the first place, that's not a great business model.
Yep.
So, yeah, typically you'll be selling options to collect the risk premium, buying tails to stop you blowing up, even though they're a loser of a bet on their own.
Yep.
Um, and yeah, a lot of it gets like at a certain point, it doesn't matter if you sell a straddle, if you sell a strangle, if you sell an at the money option and hedge it, or any of this stuff. You're either long vol or you're short vol. And if you think any of these other things are your crucial secret sauce, you probably should back up a bit because you've really missed the point.
Yep.
Like, it's a terrible thing that all those things were called strategies because
Okay.
a straddle's not a strategy. A straddle is an instrument for executing a strategy.
Yep.
Like, if someone told you, if you ask them, what's your strategy? And he says bonds, you're like, what the hell does that mean? That's not a strategy. What do you do? It's the same with straddle is not a strategy. You have to have a strategy to trade straddles. And I
Yep.
think by calling them strategies, people think that, if you do a broken wing butterfly calendar spread, it will never lose. And people often ask me about, like, what do you think of the broken wheel strategy? And I'm like, I have no idea what you're talking about. I guarantee that there's nothing special about it. Are you short vol? Are you long vol? That's the decision. And after that, you look at your risk slide and you go, ooh, I don't really want to lose $1 million if that happens, so I better buy some teenies.
Yeah.
And you know what? At that point, it doesn't really matter what teenies you buy either, because whatever you buy, you're paying too much for them. You're not really paying a great deal difference in overpriced between 5 delta and 1 delta options. I mean, they're all garbage.
Yeah.
So if people get too fixated on what strike should I buy to hedge, and I'm like, I don't know, buy whatever makes your risk slide look good.
Yeah.
I mean, literally, you can go through a ton of math here. You know, you can postulate a utility function, come up with a position that maximizes your utility for a given set of constraints. But at the end, you're going to have to put in a risk aversion parameter, which essentially is the same thing as saying, I don't know, what do you want your risk slide to look like? So it's a lot of the math really, I don't know, it's an intermediate step that if you're a quantitative hedge fund, you should go through in great detail because it matters.
Yep.
But if you're a trader and you're just punting it, that's not going to make or lose you money. That's just a very, very minor decision.
Yeah. Okay. So it's interesting. So do you think that your trading now is more on an intuitive level as opposed to, like, are you running some model and whatever the model spits out, that's what you do? Or is there like a intuitive discretionary kind of component to what you do? Does that make sense?
It's very much model driven, except that I kind of know now what the models are going to tell me.
Okay.
You know,
Yep.
the world doesn't change as much as people think, right? And I've been looking at volatility now for nearly 30 years. So I'll run the models, but if you tell me I've got a long short volatility strategy on equities, I'll be able to tell you what kind of equities you're short vol on and what kind you're long vol on. When I'm doing it, I'll have a model that exactly tells me which is the best and which is the worst and quantifies all that stuff. But a lot of what you think of as intuition is really just experience based on executing the models for so long.
Yeah. Okay. Yeah. That makes sense. And then, so if something spits out of the model that doesn't make sense, that's more interesting now than, because you've already sort of know what you think the answer should be. So if you get something unusual, that's more interesting because it's just unusual.
Yes and no.
Okay.
Like in physics, if you get something that's an exception to a model,
Yep.
or the model is predicting something that hasn't been seen in nature, that's great, because then you go and look for it, and that's the thing that can show your model has actually improved on our knowledge of the world, right? It's like, general relativity predicts this. Let's go and see. Oh my God, that's true. That's evidence in favor of general relativity. In finance, to be honest, it usually means there's a mistake in the data.
Okay.
I mean, you don't normally get really unusual effects where, say, a super high PE junky biotech stock you find really super cheap vol on.
Yeah.
It probably just means some input to your model was wrong. We're not talking about, it's not a clean, beautiful, easy thing like physics is.
Yeah. Okay. That makes sense. And then, all right, so if we're talking about the market, and this, I've got my own views about it, but I feel like we're all trading the market. Everyone's in the market, doing whatever they do in the market, but everyone's idea of the market, I think, is quite different. And your view of what the market is and how that works and interacts is probably very different than mine. So at like a really kind of high meta level, how do you think about the market, or how do you think about approaching the market, and what does the market look like? That makes sense.
No, it doesn't really make sense. I okay, here, as a I've told enough people this, it's not a shock. I've never read the Financial Times. I've
Okay.
never read the Wall Street Journal. As far as I'm concerned, that's fantasy football for dickheads.
Okay.
None of that stuff makes any difference in terms of whether you're going to make money or not. The whole idea of like, macro trading because you read The Economist and you've been watching the news, it's like, yeah, good luck with that.
Yeah.
Someone's going to make money doing that because, a million monkeys on a typewriter kind of thing. But it's the chances of you being the one to make money. If you look at the record of macro funds, it's pretty abysmal.
Yeah.
Um, so, and I just don't care. Like, I've no interest in that stuff. Like, I couldn't tell you, what the inflation number is to within 3 or 4 percentage points, right?
Yeah.
I couldn't tell you the bond yields. I couldn't tell you any of that stuff. When people say, "Oh, the Fed's doing this or that," I don't give a crap. All I need to know is the exact time that they're going to do it. And
Yeah.
because I've got this trade in the VIX exactly at that time, and it doesn't matter what they've done. I couldn't name any of the Fed governors apart from Powell.
Yeah.
That's so to me, the market's just, it's no different to like pulling up a sports betting app and looking down the list of sports. It's just a bunch of numbers. They could be anything. It
Yeah.
doesn't matter to me. Like I've traded a ton of stocks and all I knew was the ticker. So not
Yeah.
only do I not know what the business does, I don't even know the name of the company.
Yeah.
And like everyone was making fun of some guy on Twitter a few years ago about he
Yeah.
was
Yeah. I remember.
trading MicroStrategy and he didn't know what it did. And yeah, I get it because his idea was it's a fundamentally good buy because of this and this. And it turns out he didn't know what the company was.
Yeah.
But then I was making fun of him as well. And then I found out I'd actually been trading MicroStrategy options for about 2 years. And I didn't realize it was even the same ticker. I thought it was Monster. I thought it
Okay.
was Monster something. Because when you see MSTR, you're like, oh, okay, Monster. I'll
Yeah.
remember
A
Monster.
monster makes sense. Yeah. Yeah.
Yeah, and it's like it didn't make any difference to me what it was called or what it does or any of that stuff. So
Yeah.
yeah,
Okay.
to me,
And
it's just a bunch of numbers.
yeah, and I guess for you, that's your answer. Like the market is just a bunch of numbers, and you've got your model that tells you that the numbers should be here and the numbers there, so you're long or short. So
Yeah,
these days,
there's no great difference philosophically between my volatility trading and the way I bet on cricket.
yeah,
I mean, the process for where I'm looking for edge is exactly the same.
yeah, okay. So then let's just talk about that process for a second. So you've got your standard basket of strategies that you've been using, which for whatever reason aren't working, or you're looking for a new one for whatever reason. What's the process like in terms of looking for a new idea or a new approach to the market? How does that sort of evolve?
Well, evolve's a good word because you've got to be realistic with yourself. There aren't any really new approaches.
Okay.
Like if a guy comes to me and he says, well, like when I was interviewing people for trading firms, if he comes to me and says, I'm running a dispersion book, I'm long options on a bunch of single stocks, I'm short options on the index. I'm like, okay, cool, got it. I don't know the details of what you do yet, but I know that's a good thing. People have been doing it for years, well understood, makes sense, go for it, great. Now,
Yeah.
you can do that badly or you can do it well, but it's a
Yeah.
well-defined thing. Whereas if someone comes to me and says, I'm trading the market in a way no one ever has before, I'm like, that, yeah, no, you're not, mate. We've been trading this stuff for 300 or 400 years. It's like you haven't done anything different. If you
Yeah.
think you're doing something different, you've either got no clue about what everyone else is doing, or you're wrong about something else. Like, and when it comes down to it, right, it's like any strategy that makes money has got to basically be doing the same thing as the other strategies that are making money, right? So
Yeah.
if you come to me and say, I'm making money because I'm always long straddles in equity indices, well, that doesn't make any sense
Yeah.
because everyone else is making money being short those. So
Yeah.
at this point, so anyway, there aren't that many things. So really you're always looking to do is just slightly evolve or port your strategies from one place to another. So that's why crypto was good, because before everyone lost all their money in FTX, crypto was really easy because you could apply the stuff that worked in TradFi 20 years ago to crypto. So you didn't need all the super fast pipes and the really complicated execution algos. You could do all the stuff by hand on FTX. And obviously it got harder, but I don't know if you were trading crypto in like, I don't know, 2014, 2015,
No.
when there were like 50 different exchanges trading Bitcoin.
Okay.
And some of them were like three dudes with an HTML page somewhere. You know, they're based in like, I don't know, Tunisia or something, and they've got this. And Bitcoin will be trading price differentials of 10%.
Oh,
so
wow.
basically,
Okay. Yeah.
you can buy it in one place, send it over to the other place and sell it. Now there are reasons it's trading at 10%, right? There's basically credit risk because you're betting on these three guys just not stealing your money, which often they did.
Yeah.
But yeah, I mean, that was a triangle arbitrage that people would make money on with, say, gold in like the 70s. It's a very simple idea, but because of the barriers to entry and the newness and the price insensitive investors in the Bitcoin market. So often that's one of the best ways you can do things. Find a calendar effect that works in equities and say, well, how does this apply to commodities? Or how does this apply to crypto? Can I do a long short trade in crypto the same way I would do a stat arb book in equities? That kind of thing. Does momentum work in crypto?
Yeah, okay. And did you get have you been deeply involved in the crypto space at all over the years, or have you stayed away from that primarily?
I've been in and out of it. Very early on, when I had a fintech company, we did a pivot to becoming a Bitcoin trading company. And we were doing that arbitrage across different exchanges. And yeah, it was basically a big barrier to entry to get over. And that's what the trade was about. A lot of times these trades aren't about the math or the quantitative methods you're using. A lot of the time it's about, how do I set up an account in Taiwan so I can then open accounts in all of these other countries that I can't do from the US? And how do I minimize my wire transfer costs? All that kind of boring stuff. So I was in that, and then I was doing some on-chain, off-chain arbitrage stuff, which stopped when FTX blew up. And I've been running a really simple momentum strategy, cross-sectional momentum. I've been doing that for about, but not very actively. It's very difficult from the US to do it.
Sorry, just expand on that. What do you? I vaguely have an idea what you mean, but what do you mean by cross-sectional momentum? What is that, and how is that being applied?
It's essentially, you're not looking at whether something's going up or down. You're looking at whether it's going up or down relative to the other peers. So the bet is essentially that if Bitcoin, say, is outperforming, I don't know, Avalanche, it will continue to outperform. So you'd go long the one that has gone up relative to the other one and short the other one. So it's the classic way to do it is you do cross-sectional momentum and then combine it all with trend following on each individual one. So you've directional bias, but you've also got a cross-sectional trade. So that's very well known in the equity world.
Okay. So you've been doing that, and you've got your weekly option strategies and your calendar effects and that sort of thing. So, 3 or 4, maybe 5 or 6 sort of different moving parts, different strategies that are kind of working together. Is that sort of fair?
Yeah, I think in my records keeping spreadsheet, I think I've got 8 tabs. So I've got 8 strategies I consider different enough to be keeping records for. And like on one of them, I'll have like 10 different stocks, but it's all the same strategy.
Yeah.
And so like I'll have things that kind of are very similar. Like I might have something that involves selling weekly options, and I might have something else that also involves selling options on Mondays and closing that Monday night. So they're very, very highly correlated, very similar, but the actual edge, when you dig into it enough, is slightly different. So I want to P&L them separately because I want to be able to see which bit's the bit that really is making money.
Yeah, okay, that makes sense. And then, okay, so then given that you're running sort of all of these um, essentially correlated strategies or relatively correlated strategies, how do you kind of think about risk management and sort of portfolio construction and that sort of thing?
People keep asking me that, and it's really difficult because at one level, portfolio management is a very mathematical problem, right? You've got your objective function like mean variance, you've got all your constraints, and then you want to set your weights to maximize your blah, 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 blah.
Yeah.
In practice, you don't really ever do that. In practice, it's more like, do I really like this trade? If so, it will be a bigger one. Is it correlated to the other stuff I'm doing? In which case, whack its size down. Has it got negative skew? In which case, whack its size down. That kind of thing. So in practice, it's a very sort of, how do I put this? It's not discretionary, but it's much more crude. Essentially, I'm not saying, has this got an 80% correlation? Has this got a 70% correlation? I'm basically just saying, look, if everything goes to crap, do these things go to crap together? Because that's the thing I'm interested in, not the daily fluctuations. So I start everything with a Kelly criterion baseline and then apply all these other kind of things on top of it.
Yeah. Okay. That makes sense. Yeah, like I find it's funny because most of the stuff that I do is just general sort of risk premium harvesting type strategies, and it's challenging because you've come up with some idea about what your weight should be and how frequently you should rebalance and all that sort of stuff. And then obviously at a logical level, the variance in between that is just noise, and that's what you're getting paid for. But then sometimes, it is a challenge to just accept that that's the noise that you're getting paid for and that you shouldn't intervene earlier, if that makes sense. But it generally works out better, I guess, when you leave it alone, which we've talked about before. So, like, you've given us obviously like heaps of background and really good insight into, I guess, day to day how you think about the market and how you trade and that sort of thing. So maybe just take a step back, a bit more kind of lighthearted. So, like some war stories, like what's like your worst trade ever or the worst market that you've traded ever and what you've learned from it, those sorts of things.
Okay, so it's not the biggest dollar P&L loss I've ever had, but two of the biggest were due to me trading something that then got restructured in a way I didn't think could happen.
Okay.
Quite frankly, if you get blown up because the market moves, there's no excuse for that. That's entirely on you, because this is one of the reasons when people say you'll make money because of risk management. And if you back up a little bit, that can't make sense, because risk management like that is so easy. Like, it's hard to find edge. It's really easy to look at your risk slide and say, ooh, if I go down there, I'm going to blow up. Well, let's not do that. I'll buy some teenies. There you go. That's risk management. That doesn't make you any money because it's so easy. But these other things, and other people might think that this should be obvious, but none of these people mentioned it beforehand. So let's assume that I'm not the only person that got run over here. The first one was Eurostoxx options back in 1998, I think.
Okay.
Eurostox was this pan-European stock index, right? And this was really when the whole European transition to euro and integration thing was a big deal.
Yep.
So initially they listed this, and the idea was every country in the Eurozone would be represented in this index. So, you'd have a company from Portugal and then one from Luxembourg, and all of these countries had a little bit in there.
Yep.
And so because you have all these companies in there, the index had a certain dividend yield. Then one day they come along and they say, yeah, we're not doing this anymore. We're going to just put the top 25 companies of all of Europe in there. So the entire composition of the index changed. Now, the underlying price didn't change, but the dividend yield changed enormously to the point where all the forwards moved like, I don't know, 20 points overnight or something, when normally the range in the forwards be like half a point.
Yeah, right.
And
Okay.
so I just happened to have that on the wrong way. If I'd had it on the right way, I would have been
Yep.
a genius, and I'd be telling you that I knew about this in advance. And I'm sure some of the people who claim they knew about this in advance, that was what happened.
Yeah.
And a very similar thing happened to me February 2018, back when the Volmageddon. Okay, now the actual move in Volmageddon, again, like I said, that shouldn't blow you up. It didn't.
Yep.
I made it was one of the best days I've ever had when that went to the moon, because all my hedging options kicked in and everything went swimmingly. The problem was when they then reweighted UVIXI, so it was, instead of a 2 times leverage product, it was 1.5 times.
Yep.
Now, what does that do to the options? Suddenly your volatility dropped, because it was volatility is going to come in 25% immediately. And I was having all these long options, which had paid off for me brilliantly. And suddenly they're worth 25% less, every single one of them.
Okay.
And that was, again, something I was like, how did I lose all of this money on long options? The market actually moved. I've got deltas on the right way. What is going on? And then I realized it was all in Vega. It was all because of that.
Yeah.
I don't think they were allowed to do that. Like, I don't think anything in their prospectus said they could do that, apart from right at the end. They've always got something that says, oh, we can do anything we like.
Yeah.
And there were lawsuits against them. But, what am I going to do? Turn around and sue, the ETF issuer? I mean,
Yeah, it's just waste of time. Spend more money on legal fees than you will get back.
So
And
they
then,
were two worst because of something. You've got to always remember, you're never trading something real. Like even
okay.
a stock isn't real. A stock gives you a bit of ownership in a company, right? But what's a company? A company's like a really complicated set of legal contracts that talks about its obligations and its debt and its ownership and all that. Like, we think of options as really complicated, right? But like the S1 document, which is what you have to file to tell people you're going to go public. So it's not the thing you file when you're going public. It's like a warning document. And that'll typically be about 100 pages long.
Yeah.
And then you've got all the other documents after that. Like the documents for a publicly traded company, there are thousands of pages.
Yep.
The documents for an option, the option spec sheet's about 1 page. So options are much simpler in terms of that kind of meta risk. The company can start doing some, like, what was it? The Overstock, right? They went from selling garbage on the internet to being a Bitcoin investment company.
Yeah.
And they can do that. And like, the price of the stock won't jump overnight, but it's now a completely different animal. So you've got to always remember, this isn't real. These are all human constructs, and they can all get changed. And we don't think of them in those terms.
So with the two examples that you gave, do you take comfort from the fact that they didn't work for reasons that you, well, A, couldn't control, and B, were sort of completely unexpected, or is that a frustration that it's a risk that you didn't consider. Does that make sense?
Kind of neither of those things. I don't really blame myself for not considering that risk.
Yep.
But literally, you can't force yourself to imagine something you can't imagine.
Yep.
Right? It's I couldn't. I didn't know that was there. I couldn't. Like, that's literally a black swan, right? I didn't know to ask that question.
Yep.
Equally, I'm not going to be like, well, it wasn't my fault, because at a certain level, who cares? The money's gone. So justifying it like that doesn't really matter either. I did learn a bit from it. I learned that in the case of UVXY, for example, a couple of things. First, it does pay to spread between fairly similar instruments. So if you're going to be short, you're going to be short vol ETPs, be short all of them, right?
Yep.
Generally speaking, right? You know, because the borrow costs can be ridiculous or whatever. But yeah, it is worth being short UVXY and being short VXX and being short VIX futures. And they're all going to be different, but they've all got this catastrophe. The blow up risk like that is different for all of them.
Yep.
And the other thing is, people should remember, you can hedge UVXY with VXX options, and that'll hedge the market risk, but it won't hedge that kind of risk. So
Right,
you have
yeah.
to be careful. People are often like, oh, I can get a cheaper hedge by using S&P puts instead of Russell puts. And you're like, well, it's cheaper, but it's not hedging all of the risks.
Yeah, okay. It's
Cross
cheaper for a
product.
reason.
Yeah, it's like, look, if you're doing a hedge, the only reason you do a hedge is to stop yourself blowing up. Don't get smart about it. It's
Yep.
like, don't do a hedge and try and make money.
Yep.
And it's like, don't try and save money either. It's like, look, if you've been in a car crash, right? Do you tell the ambulance, take me to the cheapest hospital? Don't take me there because they charge me more. That
Yep.
doesn't make any sense in Australia, right? Because you've actually got a functioning health care system.
Yeah, here you're just like, just take me wherever, it doesn't matter.
Yeah. Take me as far as you feel like, boys. Yeah.
Yeah. Yeah, as long as you got the green pen, take you wherever you want. Um, so that's been really good actually for me to chat with you today. So I was just thinking, someone that's just kind of starting out that regrettably has stumbled across the world of options and volatility and that sort of thing, and I guess trying to find their place in the world and the market. Have you got sort of any advice for them in terms of where to start, what to read, how to sort of gain some experience in the world and learn from your mistakes and get to the point where you're comfortable in the market?
Yeah, you don't want to get to that point.
Okay.
But you've got to kind of, that's like being a bomb disposal expert and getting comfortable.
Yeah,
You've got
right.
to
Yep.
you should always be nervous, especially with a risk premium, because you get paid for a risk premium because you're taking risk. And if you take risk, occasionally you're going to get punched in the face by that thing.
Yep.
And part of the art is learning how to take those punches, but making sure none of them kill you. But
Yep.
you've got to accept you're going to get hit. And if you don't get hit, you're not doing it right because you're not taking enough risk.
Yep.
So the other thing I would say is, if I was starting now, I probably wouldn't trade options.
Okay.
I probably would stick to Delta One stuff, not just because it's easier, and it's easier to manage.
Okay.
Finding the edge is probably more difficult with Delta One stuff, right? Because it's a more
Yep.
competitive thing. But managing the risk is a lot easier. Like, I'll be short VXX and happily go away for a week. But if I'm short options, you can't really do that. You've got to be on top of them all the time, just
Yep.
because they'll blow up on you so quickly.
Yep.
So what I would say if someone's really starting out is find a couple of risk premia as your kind of core things. So maybe, I don't know, well, the only one I can really think off the top of my head would be short vol ETPs. If you short leverage ones, you've got two risk premia in there. Then you really learn how to understand it. You learn exactly why you're making money and what you're getting paid for. which a lot of people go wrong with options, right? They think they're getting money because of theta, and they're not. So that's an indication of if you don't understand where your edge is, you can't manage your risk, because risk is everything that isn't edge. Risk is all the edge is the one thing that can go right. Risk is everything else. So if you don't understand what your edge is, you can't manage the risks because you don't understand what they are either. So start by, I don't know, shorting a leveraged vol ETP and really getting to understand it. So knowing how to hedge that with options, knowing how to rebalance it so it stays at the right proportion of your portfolio, knowing when you'll get more decay, when you'll get less decay, that kind of thing. Then I'd start looking for some calendar effects. There's tons of them. Go on SSRN. Actually, go on SSRN and do a web search for a guy called Ben Jacobson, who, I don't know if he's still around, but he was a New Zealand professor at, I think, Massey. And he's written tons of studies on various calendar effects, you know, like the January effect, turn of the month effect, all that kind of stuff. The great thing about those is they're really easy to trade because you can literally set a reminder on your email. It's like 25th of the month. Oops, better buy some stocks, that kind of thing.
Okay.
So that'd be the first two I'd start with. Yeah, I think that's what I'd do.
Yeah, cool. And is there, obviously, I've sort of asked a few questions and, sort of, I guess, taken conversation sort of more where I wanted to it. Is there anything that you sort of wanted to say or wanted to sort of expand on that you haven't had a chance to? Anything that drives you nuts about what you see in the market?
People. I hate people. I guess I've been thinking, as we've been talking, I've been kind of thinking, I don't want to give people the impression I have all the answers. Now, actually, that's not true. I have a lot of answers, but that doesn't mean I'm necessarily a very good trader. I'm an okay trader, right? I mean, I've got a house, I've got stupid cars, I've got all that crap. So something's working, but I'm not a great trader because the great traders I know find one thing and hammer it forever. And they're not interested in some sort of intellectual exercise. They don't care about anything outside their little micro focus. They're not trying to understand the world in any way. They were taught something by someone else, and then they just bash it. And I'm terrible at that because I'm always trying to think about it. It's just the way I work. And I'm not saying a good thing or a bad thing. It's just the way I am. So there's no point in me saying I'm going to trade like those guys because I can't. I just don't operate that way. So I think that's the thing people have to get is a lot of trading. It's not really about thinking. It's about finding a process and just doing it and hammering it and making as much money from that process as you can. Like a lot of people get into trading because it's intellectually interesting and like you have to solve problems and all. You don't really. You have to solve one problem. And then you've solved that one problem. Now you go and beat it to death.
In some ways it should be really boring. Like, if you're solving one problem, which you understand, and you've been solving the same problem for 20 years or however long you've been doing it, there shouldn't really be any kind of thrill that comes out of trading at all. It's more process driven and mechanical rather than exciting or intellectual.
Oh, absolutely. If you're doing it right, trading's incredibly boring. And that's why sometimes I can remember these massive blow-ups I've had, and I can remember the good days. But that was really just a result of a lot of really minor decisions I've made on all these other days. So it's like, when people ask me, like, what do you think of the way the market's evolving? I'm like, I don't know. It's always the bloody same, isn't it? It's like, it's not particularly, all these things like, oh, interest rates have gone up, the yield curve's inverted, blah, blah, blah. It's like, I don't really care. I compare this number to this number, and then I bang it, and then I go and do something else.
Fair enough.
So yeah, I would say in a lot of ways, I'm not even really a trader. I'm probably more of a trading theorist and
Okay.
teacher. I mean, I trade. That's how I make my money, but I'm not a trader's trader. Like the ones who, like, if you go on Twitter, the person I think is most like this is More Protein Bars,
Yep.
who I actually worked with for briefly. That's what she does. She's traded the same thing for 20 years. She knows it inside out.
Yep.
And what she does, she can tell you every trade that happened in that product. She is like a trader's trader, right? Come in, do the job.
Yep.
Whereas I'm much more of a dilettante. If you want to ask me something about anything, I'll probably know a bit about it.
Yep.
But I'm not, most traders would not think I was really one of them. You know what I mean?
Yeah. Okay. Fair enough.
And
Don't sell
again,
yourself short though.
oh, I'm not.
Um.
It's a different job.
Yep.
It's a different life. It's like saying that, I don't know, a rugby league forward and a winger. You know,
Yeah.
they both think the other one's an idiot, right?
Yeah. True.
A lot of forwards don't think the backs actually play rugby. They think it's something that goes on that they're kind of
Yep.
necessary, but they're missing the whole point.
Yep.
It's kind of like,
Yeah. Fair enough. So then, just talk to me about your what you're up to these days in terms of, like, I know that you were doing a course with James. Are you continuing your educational stuff in the new year, or?
um, I teach a couple of other places. Like I teach at a university course here. We're going to keep the group going because that was part of the idea. I don't know if we'll get the courses again because, frankly,
Okay.
it was a huge amount of work. Um, we might. James and I are actually talking about writing a book,
Ah.
um, which would sort of be kind of along the same lines as the course, as in like quant trading for retail. So doing stuff that actually makes sense that can be done by retail. So
Yeah.
you're
Cool.
not dynamic hedging. You're not trying to out forecast, Citadel or something,
Yeah.
and stuff that actually makes money. Which there aren't many. I don't know of any books out there like that. So I think, and James is pretty funny. He'll be
Yeah. Yeah.
good.
James is a good guy.
Yeah.
Yeah. Cool. Okay. Um. Well, I'll look forward to that when that comes. So is that in the works, or is it just a thought process at this point?
I got approached by Wiley, so
Okay.
they it is in the works to that extent. Um, James has done the Kiwi thing and gone on vacation over Christmas for like 2 weeks. I think he's canceling something. So we haven't actually started or put anything on paper yet, but I
Yeah. Okay.
think 90% chance it'll happen.
Oh, awesome. That'd be great. Very exciting. Look, thanks so much for coming on the show. It's been great to have you on. It's been a really good chat for me. Obviously, you're much more well informed about certain areas of the market than I am, so it's been really enlightening to kind of hear about those, and also just to, I guess, the humility in terms of, that you don't think you have all the answers, and that you like all of us, you're just sort of trying and doing your best and making mistakes along the way. So thank you. If anyone wants to reach out and say good day or has any questions, how can people do that? Are you on Twitter these days or not really?
Technically, I'm on Twitter. I don't really post there anymore. I've had so many problems with, fake accounts and Twitter don't give a crap anymore.
Yeah.
Um, so you can DM me through there, and I check it like once every 2 or 3 weeks. So that's probably the best way.
Okay. I'll post your handle up in the comments. And once again, thanks for coming on the show. Hope everyone enjoyed the show. And we'll see you next time. Thanks again. Peace.
Thanks for talking to me. Thank you.
Cheers.